Hello, everyone, and welcome to the Merk Webinar. On today's presentation, we'll be going over our outlook for 2019, its global themes, our view on the economy and investing, as well as how to position your portfolio for it all. And on the line, we have Merck's President and Chief Investment Officer, Axel Merk. And just some announcements before we start. We will be having our quarterly Outlook webinar on January 24th of next year, 2019. At the end of today's presentation, we'll have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during the presentation. You can do so by typing it into the questions box on your screen. This presentation will be recorded, and with that, I will now turn the call over to Axel to begin the presentation. Axel?
Thank you, David, and welcome everybody. And so, yes, our January webinar will be focusing on our funds, on our products and the services, whereas today's webinar is really our crystal ball. And in recent years, with the market having gone up and up and up and up, these sort of outlook calls were, I don't know, bemusement entertainment for many. People like listening to kind of the oddball view out there, but didn't really take it seriously because, hey, markets go up, don't they? And now in recent weeks, we've had increased volatility, and so people are starting to pay attention again to what the crystal ball says. Now, as I have said in past years, though, I have my views of what's going to happen. I have no assurance that I'll be right. We put significant emphasis into studying everything that's out there. But I see my primary role in making people aware of certain risks out there, of having you think a little bit outside of the box, of either staying calm in turbulent times or being nervous in calm times. I provide, of course, no assurance that I will be right, but I do often usually put my money where my mouth is. So with all that introduction, I will talk about, firstly, about the S&P here a little bit in general. Then I'll do a significant detour into what's happening in the economy. I'll talk about what's happening with inflation, with the Federal Reserve, and then shift gear more towards what's happening in the Eurozone, and then more broadly internationally, including China. And of course, I'll touch on gold as well. There's always significant interest in there. By the way, these Outlook webinars are some of our most popular ones, and so we have a very significant attendance. Please feel free to drop questions at any time in the Q&A box. We'll try to get to many, and then if we can't get to them to you, then we'll try to go afterwards. The other day, I had a chat and was asked, why do we talk so much about the S&P 500 when a lot of what we do at Merck is actually not directly equity related? Well, first of all, we do quite a few things at Merck these days, including equities. But the reason why we talk about equities is because we use equities a little bit as a proxy for risk assets. When the mood is good, equities tend to go higher. And there are also several other things. For example, as you can see in this chart here, historically speaking, the S&P 500 has done quite well during economic expansions and rather poorly in recessions. Most of the bear markets, defined as a decline of 20% or more from the peak, have happened during recessions. Now, some caveats. There are exceptions. 1987, maybe the biggest, best-known one. And the other one is, of course, that you don't know whether there is a recession often until well into it. But because of that, it is very important for us to kind of look at when are recessions, and through that have a notion of what to do with the risk assets. And if you translate that to your portfolio or investor's portfolio, it means a lot about kind of how you should think about the risks in your portfolio. Now, everybody knows that timing the markets is difficult, but everybody has a different investment process. And at the very least, I would encourage people to rebalance to whatever the approach they have. And even for that, it is sometimes helpful to know. And also, if you are an investor who kind of says, all right, this is my risk tolerance, whatever that abstract notion may mean, well, when risk in the market goes up, doesn't that have implication for your asset allocation? And so with that said, let's dive into some of these charts. We have quite a few. We may take a little bit more than an hour today, so I'll try to address everything. But the here, just looking at the economy, leading economic indicators, we only have here 2 recessions on the chart, but still, we use these as kind of as reference points. And as you are well aware, we publish research reports. If you subscribe to our newsletter, then you will get these, and we have on different topics, and one of them is on a business cycle, where we try to dive into this in more detail. But the short of it is that we do not see that the next recession is just around the corner. Now, just put this into context of the markets we've had in recent days, where there have been very significant jitters in the markets. And of course, one of the roles we see ourselves in doing is we're trying to gauge the newspapers today, or online sources said, hey, the market plunged because of the arrest of the CFO of the Chinese telecom equipment maker. And the question to us is, well, is that really the case? And if so, what are the implications? Or is it just that when we had a day off, the markets rebounded a little bit and they wanted to dip down again, and it just happened to coincide with the arrest? And so the media always tends to put things in with hindsight. Now, we don't know which of these storylines is true. The question is whether it really matters or not. I do think it matters. I do think it matters a great deal whether the market does get spooked about trade, whether this is an escalation that will mean that there's not going to be a trade deal with China, which means that trade tensions are going to escalate, potentially like in the 1930s, and the world is going to fall apart. Or does it mean, hey, is this just a negotiating tactic? Or is this, for example, a renegade prosecutor that's going after the CFO? Now, new news have been trickling out, and it appears that Huawei has been violating some rules, at least allegedly, and that this is a step to clamp down on that, and that this is just happening in the background, everything else. And by the way, it may well be that one of the reasons why the Chinese didn't react to Trump's announcement that everything is dandy on the trade front is because this just happened. The CFO was actually arrested on December 1st already. It was just yesterday that it was announced. So here, once more, a chart on leading economic indicators, broader context of how they do with regard to recessions. And this is the year-over-year change. So yes, there's been some loss in momentum, but we are far away, according to this metric, from a recession. Yield curve steepness. Many of these charts here were as of last Friday. Significant moves in the markets have happened since then, and so bear with us. We just can't update these things live when we do these webinars. One or two of these charts are more up to date, but many of them are a couple of days old. This is relating the 3-year yield versus the 10-year yield. The reason we use that is simply because we have the data that go back that far. Quite often when you hear about the steepness of the yield curves, it takes the difference between the 2-year and the 10-year. But the picture is similar. The difference in the 2s, 10s curves as of right now is 13 basis points. Just as a word of caution, I do have a Bloomberg terminal open in a different window. Sometimes my PowerPoint crashes when I do that. And so if it does, please bear with me until I bring it back up. So in any case, the yield curve has flattened. And there's been a lot of screaming about, oh, the next recession is around the corner because the yield curve might invert. Historically, it takes about 2 years after the yield curve inverts until there's a recession. Now, granted, sometimes a little faster. The more important thing, I believe, is keep in mind that there is no coincidence why the yield curve inverts. It's usually because the Federal Reserve needs to take the foot off the accelerator, possibly apply the brakes, because you have inflationary pressures rising. And so they just do what they got to do. Now, they don't really want to have a recession, but they maybe have their hands tied because of it. Now, if you look at the market moves in recent days with bonds rallying, maybe nothing is there to be concerned about, but we'll get to that here in a minute. Earnings, we've lost some momentum in earnings, but we're still expecting earnings growth. And so, of course, the question is, well, are we maybe still at the peak in the market just because stocks had gone up so much until now? And so the only answer I can do to that is that nobody, well, by chance, somebody will tell you exactly when the peak of the market is. But odds are that you or I will not be able to identify the exact peak. So instead, what you should have is an investment process that takes that into account, right? Do you want to max it out, that you hit the peak of the market? One of the reasons, by the way, people are so reluctant to diversify is because of the tax hit, right? When you sell equities, then usually you have to pay capital gains taxes. And so that's why there's this reluctance, and that's why people are so reluctant, and then they wait until they no longer have a gain, and then they sell, but that's exactly when the stocks go back up. Purchasing manager indices. Here we have a little glimpse of what's happening internationally. The black line, that's the S&P 500. The red line is the purchasing manager index in the US. 50 is considered the magic line between expansion and recession. And then we have several other major economies, and the gray one is China. And of course, that's been getting a lot of attention here, hovering at 50 most recently. And then we got Japan is up there. But look at the German line. That's been steadily declining, and you would think that the world is coming to an end in Germany. I happen to be far more optimistic on Europe than many others have, and this is becoming the minority view right now. But there are substantial unique factors that have contributed to this PMI going down. And they're not the sort of factors you would typically think of. One of them is the drought you've had in Europe. The drought does have an impact. Believe it or not, a significant amount of commerce is happening on rivers in Germany. They do ship goods from north to south and vice versa. And due to the drought, they could barely ship any goods. And so that has caused a significant slowdown, which is rather unusual in Germany. The other one, also a European issue, Germany was hit particularly hard by that, is there are new emission standards in Germany. And as there are new emission standards, you need new testing equipment, and the testing equipment hasn't been ready. So they literally couldn't sell cars, and that caused quite some disruption. And so that's a big reason why the purchasing manager indices and many other indicators have come down. Now, there are some leading indicators in Europe that are more sentiment-based. They've also come down because, in my view, the Europeans haven't quite gotten used to the tweets of our commander-in-chief in the US, and so they tend to take these a little bit more seriously. Now, grant you, they can have a real impact on investment decisions. And then, of course, yes, trade has had an impact. There has been a slowdown. The question is it quite that much? I believe firmly there will be a rebound in these numbers. The question is, to what extent will there be a rebound? And of course, to what extent will it lift certain prices and expectations? Back to the US, building permits. There's a slowdown in building permits. The question is, how far will it tip over? The high interest rates, obviously, the housing sector is particularly sensitive to that. Living in one of the most expensive housing markets in the US, I certainly see that there's softness in the housing market as well. More broadly speaking, keep in mind that housing is about half the weight of the US economy as it was heading into the 2008 crisis. And so while a slowdown in housing is certainly important and relevant, it is not as important as it had been previously. New home sales, similarly here, they have come down, driven by higher rates to an extent anyway. Oil production. I believe it was this morning, headline out that the US has become a net exporter for the first time in a very, very, very long time. And that is due to fracking. Production has been ramped up rather dramatically in recent years. It's quite stunning. That does have significant implications, of course, for many, many things. But in 2016, when we had the scare in fracking, it was that people thought, oh my God, financing is drying up. There are going to be lots of bankruptcies. Many of the fracking companies are small companies. They're marginal producers. And if they topple down, well, they'll have toppled down, but they can get back on their feet. There is actually a lot of incentive right now to produce a significant amount. And part of it is because many of these folks are hedged. And so they can continue producing and can sustain low oil prices should they persist. And so it's one of the reasons you don't see as much blowout in the financing costs in that sector, is because it is actually, despite the prices that have come down, it's It's more stable. Everybody's aware of the unemployment rate that has been coming down. Now, I speak in the eve of the new non-farm payroll report. The question is, at what time will this turn back up? We use the moving average here as well, a longer 12-month moving average. And here in the last 2 recessions, we kind of had that swing back up. Will we exhaust the pool of available labor? I think that is most relevant to gauge about whether we'll have a slowdown. And as you can see here, many of these metrics, they look very dandy, right? I mean, we get a tweet storm here and there, but things look decent. Household delinquency. This is kind of a measure of consumer credit. Households are healthy, despite what some people are saying. So they are able to spend money. And by the way, just shifting back over to Europe as well, despite all the bad things we all hear about Europe, European consumers are in a reasonably good shape as well. Pensions in Germany, I think, are scheduled to go up about 3% in January. That is quite a nice boost to the spending power. And so it's one of the reasons why Draghi, the head of the ECB, has been more positive. U.S. lending standards. This may be, we talk a lot about, the stock market goes down. Hey, that means interest rates are not going to go up any further. I have to disappoint you, but it is not the Fed's job to manage the S&P 500. People have that notion, and I apologize to anybody who have heard me say this before in recent months, but I'll repeat it again. It was in 2008 that, yes, a lower S&P equated to Fed easing, not so much because the Fed S&P went down, but because the credit market seized up, credit conditions deteriorated, and because of the reduced flow or the seizing of credit in the economy, valuations in the equity markets also came down. But the Fed does not, by its nature, worry about the S&P 500. Now, surely Greenspan was somebody who believed very strong in the wealth effect, so maybe there was a little bit of that. But there's a lot of noise out there. Kaplan, the Dallas Fed president, was quoted today again. About saying, oh, we can take our time, we can wait. And a few minutes before I started, Wall Street Journal published an article where they say, hey, the Fed might have more of a wait-and-see approach. Maybe. But what they're really watching is this chart here, or charts like this, but this in particular. This is a survey of senior loan officers, which means that what do the banks say? How easily do they make credit available? And as you can see, in recessions, in significant downturns, those credit conditions deteriorate rather substantially. We are not there. The very point, by the way, of raising rates is to tighten financial conditions. It's the very point. That's why they're doing this. They want to take the foot off the accelerator. And as Mr. Powell has said, we are still in an accommodative position. And by the way, the other day when Powell was quoted to say we are very near the lower bound of the neutral rate, the market took it completely wrong. It was below the lower rate of what some people in the market believe is the lower rate, not what the Fed believes is the lower rate. A. B. Everybody at the Fed would agree there is no such thing as a precise level of that neutral rate. And furthermore, Powell has indicated he may have to go above neutral. So the Fed is far from being done. Now, you wouldn't know it if you look at the markets. Today, at some point at the low in the market, the Fed was pricing in one more rate hike this year and less than one for next year. To me, given my current assessment, that is absurd. And I acted accordingly and traded that and by the way, when I talk about trading positions, this is not a fund presentation, so this would not be in anything that we have in any of our products that we publicly market. So anyways, another metric of credit conditions, again, as of November 30th, the high yield spreads, that's the spread of the junk bonds, of non-investment grade bonds versus corporate versus treasuries. And so, yes, that has gotten up a little bit. but we're not at levels where we kind of have to fear about recession. Now, granted, if you look at some of these, that can change pretty quickly. And most notably, there is a lot of that sitting at the low end of the investment grade side that might be pushed into the junk status. General Electric was quoted as potentially being downgraded. We're not giving a recommendation here on anything specific and not making a forecast. The point still being is there's a lot down there. And if you have some downgrades, the investment grade market is so much larger, and there's a lot of stuff sitting at the low end of the investment grade. And when something is pushed to high yield, to non-investment grade, it might overwhelm the market. And the reason this happens is that it tends to be a different buyer that buys the so-called safe asset versus this so-called risky assets or very risky assets. Now, a few things to put this into context. It's one thing for that to happen with sovereign debt in the Eurozone. So when people buy Greek debt thinking it is safe, and then suddenly they realize, oh my God, it is not safe. That is a big problem. But if you're at the low end of the investment grade, everybody knows these aren't treasuries. So it's not like the markets are going to be completely shocked if it were to be downgraded. Now, it is still a bit of a concern because if you look at index funds or some institutions, they're just not allowed to touch that stuff, and when it's not rated properly. But a lot of people have reduced their reliance on the rating agencies and come up with their own assessment. And so, again, if you have a downgrade of a big issuer, yes, it's noteworthy. Yes, it's another piece of the puzzle that we're moving closer towards a recession. But it doesn't mean that this is done. Just like the inversion of the yield curve doesn't mean it's a done deal. And historically speaking, the market, the S&P tends to make a new high before that. Now, I'm not saying that it will necessarily, but if you're thinking about shorting the market, just be careful, because you might be wrong, because there will be some bad news, and sure enough, it may not yet mean that there is a recession. Consumer confidence. Look like there's a lot of happy campers out there. People are very confident. Some people say, hey, if you ask Republicans versus Democrats, you get different answers. But the short of it is that, if anything, you have a contrarian indicator here that people are quite confident things should move on. Now, again, this was as of November 30th, before we were told that the world is coming to an end because some Chinese CFO gets arrested. Quits rate, very relevant to the Yellen Fed. We don't have the Yellen Fed anymore. But keep in mind, Powell is a lawyer. He is not a PhD economist. He listens to his staff. A lot of the staff of the Fed that Powell listens to was managed under Yellen. And so there is still that kind of carry through from that. And so something like the JOLTS report, where it shows how actively people are looking for jobs, it's very relevant. And I think we have more, there are more job numbers here, job-related numbers here. And let me just talk about this here a little bit more. People on disability are coming off disability. Here, the big question is, how far can this be coming down in this economic expansion? People are incentivized to go back to the workforce, having previously claimed disability. I'm not saying that they were, quote unquote, faking it. Of course, there are always some amongst them. But still, it's always a question of incentives, of whether you prefer to collect disability or try to join the workforce. And this number has been coming down. As long as that keeps coming down, there might be enough, quote unquote, slack in the economy. We have put up this chart here before about, we call it the Powell labor market slack indicator. It's our interpretation of how Powell might be thinking about this. Note that this one here looks at the labor participation rate of so-called prime age males. Those are people from 25 to 54. As a reference point, and these are men, if we go through this line here, and note this is not a scientifically plotted line, this is just a line that a crude approximation, that if we get through this, then we might have a serious issue that people may not be available to join the labor pool anymore. Another one, we don't have the slide here, but a lot of older people have been joining the labor force. Not so much actually in the US, where this has happened for some time. In Europe, it's happening to a very substantial degree, where a lot of the people from 55 to 70 are joining labor force that were previously not in labor force. But here in the US, we have a few more months here, but I am very concerned that inflationary pressures are going to increase. Some economists have come out in recent days and said, oh, housing market is soft, therefore inflation is coming down. We're going to get a prescription laws that take down prescription prices. We're not going to have inflation. I do happen to think it is very important to look at wage pressures. I think we have a chart here on wage pressures coming up in a moment. I can just look up here. Yep, there's one coming up here in a second. And so looking at inflation, these are the different inflation readings. Again, please submit if you want to have a copy of these slides. The core PCE is kind of what the Fed often trumpets. These are the core numbers, obviously excluding food and energy. And PCE is a different way of looking at inflation versus the CPI. In any case, we are hovering around 2% on these core numbers, and even a tad above it. And so the question is this a time for the Fed to be on the accelerator, as it is? You tell me looking at that. Now, there's another way of looking at it. What are inflation expectations? There are many ways to measure inflation expectations. This is a market-based one, the so-called break-even rate, where you take the difference between treasuries and TIPS, the inflation-protected securities. They have shown that inflation expectations have been coming down, basically a reflection of the rally that we've seen in treasuries. The Fed prefers to look at survey-based ones. They're very sluggish, and they don't move so much and so fast, and you can justify just about anything with it. It's one of the reasons why we can look at inflation numbers all the time. The Fed can really read into these numbers anything they wish. Now, the one thing I think it is extremely relevant for next year, and the one reason why I do think the Fed will continue hiking rates, is because we got the employment cost index here moving higher, and steadily so. I mean, yes, sure, there is a tad of a flat line here, but to me, this is inflationary. And this is what will get the Fed to tighten. This is what will get the Fed to tighten into a slowing economy as that moves higher. Now, maybe there's some miracle that more people are moving to the sidelines, from the sidelines to the job market. Maybe the housing market is going to be so weak that somehow inflation is going to be shrugged off. Maybe we're going to have legislation that prescription is all going to be made available for free at nobody's cost. I shouldn't joke about prescription prices because they are a significant component of inflation, but I call me a traditionalist. I happen to think when the labor market is tight as it is, we are at above 2% inflation, which the inflation target is. Sure, we are not at any alarming level, absolutely not. But it is not a level where the Fed should be asleep at the wheel and saying, hey, we got the luxury to wait. No, the Fed does not have the luxury to wait. The Fed has an obligation to move to neutral so this doesn't break out. And even at this level, the Fed, at Powell's admission or statement, is at below what even the most dovish folks think is neutral. So yes, the Fed will have to continue to hike. That's my reading of it. And with that, of course, implications for risk assets. I have indicated many times that QE has compressed risk premia, and so as a result, quantitative tightening will increase risk premia. Compressed risk premia means low perceived risk, low volatility. Higher risk premium means more volatility in the market. And guess what? Volatility in the market has increased. That doesn't mean that the markets are going to crash and go to zero, but it means that better get used to days we've had of late, because we'll see more of that as rates move higher. Wage inflation versus unemployment. So here, this is the relationship that many people are putting into context here. Wages versus inflation, the so-called Phillips curve. And some people ask, oh, is the Phillips curve dead? Is it not dead? Once Tom Keene of Bloomberg Radio asked me if the Phillips curve is dead, and I said, of course it's dead. Well, there are two ways of thinking that it's quote-unquote dead. One is what presumably he meant, but I didn't get it when he asked me at the time, is that can there be wage inflation without there being inflation in general? Can the unemployment rate come lower and that not be too inflationary? My way of saying it's dead is just because the relationship has always been a bad relationship. You cannot use this as your best indicator. There are many factors driving it. More importantly, wage pressures going higher can be quite inflationary, like in the 1970s. You cannot try to over-engineer this. Anyways, here's yet another chart of this. Let me go on here. Fed rate hikes being priced in for 2018 and 2019. So 2017 was the first year that the Fed hiked rates more than was priced in at the beginning of the year. 2018 is panning out to be another one. Currently, we're planning to, just help you understand this chart, to be, currently, that's as of November 30th, we're planning to be 1.29% higher at the end of 2019 than we were at the beginning of 2018. And if I can just here make a brief math on my calculator, that same equivalent number has moved down to 1.205 as of the market close today. And so, yes, we've moved further down, but we're still above what we had at the beginning of the year. I would predict that at this stage, we're going to have in 2019 more rate hikes that are priced into the market. Now, if you look at kind of my performance in recent week on that, these rate hike expectations have been coming down, so I may look like an idiot. I look like a genius maybe if you look at it from the beginning of the year. So timing, I guess, is everything. To me, I have taken increased positions to that rates may be moving higher. Again, this is an investment advice. If you want to learn how to take such positions, drop me a note here in the Q&A box. We can't help everybody on these, but for certain people, those things might be suitable, and we can discuss that with you. In any case, financial conditions, again, jumping back here, these are the rate hikes, financial conditions based on the Chicago Fed Financial Conditions Index. They are dandy. This is one of the better financial condition indices. Bloomberg has one that I don't like because it takes just stock market volatility as a very significant weight. Stock market volatility is not what drives the Fed. It will drive some people at the Fed, but not the Fed itself. Fed assets have been coming down, and so this is quantitative tightening. We have fully ramped up the program. It doesn't mean we will have the balance sheet reduced by the full $50 billion a month every month, but the program is just because how these maturities are staggered. But it somehow my mouse likes to move back here. Sorry about that. But we are still in real tightening mode at the Fed. Here, overlaying the balance sheet of the Fed with the S&P 500, and so clearly there is some nervousness, and some people argue, hey, look at this correlation. Maybe it's the Fed that's been driving this growth here. Obviously, we've had earnings as well. Let's have a brief look at who is negative in the world, and with that, move a tad more towards international. Bank of Japan obviously is negative. European Central Bank has been negative. The Riksbank, those are the Swedes, have been negative, and then the Swiss National Bank has been negative. And so the question is, how much will we see moving higher in the rest of the world? And just before we go to that, the total, if you take global debt that's negative yielding, these are Bloomberg metrics. This has moved now a tad higher again. The recent risk-off environment has pushed rates lower, and so these things tend to swing around, mostly with what's happening in Japan right now. This is a bit of a checkerboard, and so apologies, we usually don't like to put so many charts in there, but I want to give you a little bit of feeling that here's the US on the black line to 2.25 that's moving higher. The US isn't the only country that's been moving higher. Canada has been moving higher, and just overnight, rate hike expectations have come down quite a bit in Canada, but generally speaking, Polos has been reasonably hawkish. We've had here, the UK has been moving higher. We've had Norway moving higher. Not only has Norway moved higher, sorry about that. We have had Norway reduce the inflation target that they have, and so with that, have a more incentive to move higher. And then we do have here several that have been flatlining, and we also have Japan has had multiple different policies. So this line that's just a short stretch here is the targeting that Japan had in place here for its 10-year target. But the question is, will others move higher? I had shown you here just before on Sweden, if I go back to, that the blue line here has been flatlining. For the longest time, Sweden has been arguing that they want low rates, they don't want to raise before the Eurozone. And by the way, the Swedish krona is the worst performing G10 currency year to date. But if you look at inflation in Sweden, look at that. It is above their target. The policy is working. They're getting their inflation. And guess what? Of late, the Swedish Riksbank has been talking hawkishly that they need to move higher. You wouldn't necessarily notice it based on the Swedish krona still lagging. But in my view, it is very likely that they will get away from zero. So this move away from negative rate continues despite this risk-off environment. Let's look at the big boy outside of the US. These are the main inflation metrics used in the Eurozone. There are various indicators in Europe. These are the quote-unquote official ones. And one thing to keep in mind, and if you listen to Draghi, you wouldn't know it, in the Eurozone, headline inflation is the target, so including food and energy. And Draghi's predecessors always took this very seriously. Draghi doesn't seem to take it seriously. But keep in mind a few things. Draghi is retiring in a year, and so the successor just might take it seriously. Also, Draghi has been talking rather hawkishly of late, saying, yes, the QE is going to end of this month, and we'll know more about this in a few days when the ECB meets, but that's baked in by many people. We would agree with that. And then Yellen and Bernanke both wanted to tie up loose strings and were a tad more hawkish, tighter at the end than you would have normally thought they would be. Similarly, Draghi, probably for his legacy, wants to say he was able to raise rates. Now, there's no guarantee that he will, but from that, I would think there is still this chance that he will hike rates just for the sake of it. Well, I think I have Italy here. Let me just move forward. Yeah, Italy, here we go. There's Italian economic sentiment. The Italian sentiment has been coming down a little bit. We are above 100 here. Just keep that in mind. Importantly, let's have a look here. Italy deficit and the debt to GDP ratio. The deficits in Italy have been coming down steadily in recent years. Indeed, Italy has had a primary surplus. That's the deficit before interest payments. The challenge that Italy has is this high total debt. And in that context, the reason there's so much fuss about all of this is because there's an agreement in the Eurozone, the Maastricht criteria, that if your debt is above 60% of GDP, you want to take measures to get your deficit down to 60% of GDP. And they're the good Germans that with German stoic discipline are actually doing it. And they're getting a lot of heat for not spending enough money. But they're actually coming down to 60%. And then you see here Spain as well, and in Italy, I'm just in France here. Is here the Italians are hovering up there at 133. And so the EU is telling Italy, hey, you guys got to get your deficit from here to down there. I don't know whether you can see the mouse. It hasn't happened. And now you have a populist government that doesn't want to do it, and so they're creating this big fuss. But at the same time, by any reasonable metric, they have been doing all right. Now, clearly, some of the policies they're proposing might permanently increase the deficit, and so that's one of the reasons why the EU is pushing back. The other one is that they want to impose some sort of discipline. They think they can do it. But also keep in mind, this is a lot of that, in my view, is politics, and politics only. Salvini, the prime minister in Italy, has said they're going to find a compromise. Just given how history probably works, they have about 6 months before they would be slapped with fines. So expect that they have a compromise in 5.5 months. And the only thing they really need to do is they need to privatize something, and they can have all the social policies. Now, I'm not suggesting that's the best thing for them to do, but by privatizing something, they can add it to the income for the year based on how the accounting works in the Eurozone, and they will not get punished. And so there is a way for them, for the populist government, to be populist without getting fined. And then if that crisis is averted, which may happen in 3 months or so, maybe 6 months, you have the room open for an interest rate hike. So I'm just saying that in that context as well, the odds of rates moving higher continue to be there. Lending standards in the Eurozone, so similar to the US, hey, credit is not tight in Europe as a reference point. Unemployment rate has been coming down. Now, if you hear Italy is a blue line, it's stubbornly high here at 10%. They do need more structural reform. I'm not saying everything the Italians are doing is great. They should be doing more. Spain, they've had obviously a major crisis, have come down substantially. There's a lot of a gray market economy in Spain. So just because the unemployment rate is 14% doesn't mean nobody's working. But one of the things that's been happening in Spain, you've had a significant recovery in the housing market. I don't have a chart on that here. And so, yes, there are challenges in the Eurozone, but it is not as bad as many people often make you feel it might be. China. Lots of things to be said about China. Ray Dalio just gave an interview, a podcast that's available. Bloomberg Masters is the podcast series. You may want to listen to it. And he was asked about the debt in China. And he said, and I would fully agree, is a lot of the debt in China is domestic debt. They can address that with various means. And as far as capital flight is concerned, yes, reserves have been coming down, but we're still at 3 trillion. They can manage where they are right now. And so in order to get kind of the not more of an outflow, one of the things, I think it's on the next chart, is they've had more capital controls. That has reduced direct foreign investments and foreign direct investments. And so there are some net outflows here. But China can manage the sort of environment that they're in. And China is doing a lot to try to reorient its economy. It just has to deal with the cards it's dealt with. And I sound here very optimistic about everything. I'm not suggesting that the stock market is going to double from here, just in case you're wondering. I'm just trying to give you guys food for thought when everybody is negative, that there are reasons why that there are some bright spots here in the world, that things aren't quite as negative as you might think. And more importantly, that rates are going to continue to move higher. And so, of course, higher rates will provide a headwind to assets. Here, the China, the Shenzhen CSI 300 index, again, this is of November 30th. So that has done extremely poorly this year. And the question is whether it's going to rebound, right? I mean, you usually want to look at things when there's blood in the street. Now, if you think that we're going to have a recession in the U.S. and things are going to deteriorate in the U.S., maybe things are going to move lower. By the way, if you are considering to buy stocks in China, there are several different indices, different ways to do it. They have very different compositions. So I'd encourage anybody to do their homework on it, whether you want to kind of look more at the tech sector or want to look more at some of the industrial companies and the like. And so there are different ways of investing in China. S&P 500, we don't show many technical charts, and so we'll leave it at a very simple one here. If you take a logarithmic y-axis, and we're kind of still in that channel. We haven't broken down. And the question is, of course, it is quite far down from the top to the bottom of the channel. But if you think things are really going to get bad, the argument is, hey, you have plenty of time to sell if you were going to break below any of these channels. And that's, of course, one of the views in the view that, hey, you want to be optimistic until there's a recession, because then there's plenty of time to sell. My own view is that taking chips off the table as we're aging in the bull market is probably not a bad idea, because it will rebalance, not on the one hand the portfolio, but that's not the main thing. The main point of that is you rebalance the risk in the portfolio. You're moving from higher risk items to lower risk items. And so that's one of the things you manage. And the question is, of course, how to do it. I'm not a fan of a traditional risk parity strategy. I think they can blow up in your face. But the idea of moving to something that is less risky, and with that, of course, in a current environment, the main thing is to worry about is about the correlation. Here's an underwater chart in the S&P 500. That is how many percent you are down from the most recent high. It comes from the kind of low in the market in 2009. Again, this is as of November 30th. And so we have not come to bear market territory since. But yes, in 2011, we got close to it. In 2016, it was a sign of issues that we were in the last inning type of thing. Heard that many times over. And clearly, volatility has moved higher. But the question is where are we going to go from here? And everything I'm telling you right now is that the bulls are not going to get buried quite yet, because the economy isn't quite quite moving over yet. And so let me talk about gold here a little bit. I use gold here as a proxy, as a diversifier. I've often called gold the easiest diversifier. And that is because since the beginning of this chart, it has had a correlation to the S&P 500 of just about 0. Now, zero correlation does not mean inverse relationship. It means there is no relationship in the long run. One thing that has happened in every recession, with the major exception of the early 1980s recession, is that the price of gold went up when the S&P had a drawdown of more than 20%. And the key metric here in 1980 is that real interest rates went very high in 1980. Now, if you're confused about what I've been telling you, then you probably have a right to be, because I've just been telling you that rates are going to continue to move higher. My view is that even though rates are going to move higher, they are not going to move higher in a Volcker-style manner. They're moving higher because inflationary pressures are going to continue to increase. And that is also one of the key reasons why price of gold has kind of been hovering around here, has gradually been grinding higher a little bit. The reason, in my view, why gold has been grinding higher is because volatility has been moving higher. When volatility is higher, then risk assets get discounted more, making something that doesn't have a cash flow more valuable, relatively speaking. That's my view, at least. And so that's in this context that's been moving higher. Gold, in my view, is going to break out on the upside if and when the investors believe that we're done with a hiking cycle in earnest, that we're looking kind of at the next downturn when rates may have to be pulled down substantially. That's, in my view, when gold is going to take off. And so the fact that gold is behaving, quote unquote, reasonably well is, to me, proof that the market is wrong when it says, that based on the Fed funds futures, that the rate hikes are pretty much taken off the table. And so, to me, that is one other indication. Now, questions again: when do you buy gold? Right? It's one of these things. As a diversifier, you may want to have it, and then you may want to increase it. Now, going beyond that, there are, of course, other diversifiers. As you're well aware, we do a lot of work on the currency, on the non-directional currency side. The advantage being is if you do anything that's long-short, that is how you can create a return stream that almost by definition is uncorrelated to risk assets, be that long-short equities, long-short currencies. Problem is, most of these strategies are complex, and people are shying away from that. The other thing to diversify is cash. Cash is king, right? And indeed, you're actually getting rewarded with cash these days. If I look at 4-week Treasury bills, 2.26 or so% in yield right now, and so you're getting compensated for holding cash. And a lot of people, and by the way, this isn't supposed to be investment advice, but look at how much cash you hold in your checking account. And lots of people who hold cash there that doesn't need to be there, and you're giving the money basically away to the bank. We could be buying treasuries, and if you have significant cash there, that's a very simple thing you can do to get a few bucks extra in your pocketbook. Anyway. This was kind of a quick run around the world. I see we have many questions that have been submitted, so I'll pause here. And before I pause, let me just do a very quick pitch for our service in general. We got our research service these days. This is not a presentation about funds, so I'll pitch those to you some other time. We do provide more broader advisory services these days. If you want to get help on what to do with interest rates, if you want to get your portfolio reviewed, we might be able to help you. We can't do this for everybody, but for certain profiles we can do it. And when can provide certain services that you more typically see on a kind of more high-touch concierge type of service. But we do provide some assistance to people that look for it. So we have some of that information at merkinvestments.com as well. And so with that, David, if you want to mention the Q&A.
Great, thanks, Axel. Yes, please now take a few minutes to read the following disclosure right in front of you as we move to the Q&A portion of our call. Again, I would just like to remind everyone that you can still ask a question by typing it into your text box. So our first question comes from Zach, and the question is, will the Bank of Japan continue to tighten? Why is gold going sideways? Axel?
Yeah, sure. I think I addressed the question on gold, and I'm not going to repeat that now. Regarding Japan, just very briefly, the Bank of Japan has many different policies. I don't think they quite know themselves exactly what to do. Inflation has been ticking up in Japan, and so with that, they are also feeling a tad encouraged that they can move a little bit higher. You haven't really seen the yen rally in risk-off days, and so part of that is because of that widening gap in the yield that you just get in the US, and people haven't quite used the yen as the quote unquote safe haven asset. I don't think they'll move very high, but they haven't engaged in much QE because they haven't felt any need to do it, and so they have quote unquote tightened a little bit. I think they'll continue to be on just that very, very gradual course, but everything the Japanese do is going to be in tiny steps. David.
Okay, next question comes from E. Willard, and the question is, do you believe that there will be a reset of the financial system? If so, when will it likely take place, and what do you think it will look like? Axel?
How many hours do you have for me to address that question? What I would encourage anybody who kind of has these sort of thoughts to do is get a copy of the book Lords of Finance, the bankers who broke the world, I believe is the title. And the reason I encourage you to do that is because that is a time when we've had a few resets in the financial system. And it shows you the type of things that happen going into those sort of things. The question is, why would you have a reset? And if you just think about it, in the world of currency, let's take it from that perspective, right? And your own finance as a government. You can, of course, control the expenses you have, the budget, the revenue and expenses you can control. And then more broadly, in an international system, you can control interest rates, try to move the economy that way. You can try to control the exchange rate. You beggar thy neighbor, you devalue and fix your exchange rate, or you can possibly introduce capital controls. But fixing all the more restrictive you're on one, you can kind of fix one of the three. And so a modern open economy tries to control the interest rates. They like to have control over credit. The moment you start controlling two of these three factors, you're going to create a situation where you can have a breakdown. And so the Chinese, for example, they control capital flows. And so with that, they can get away controlling the exchange rate, but they have lost flexibility over interest rates. And so now they start to have some issues. In order for the financial system to break down, I think you would have to have more restrictive policies around the world. Now, that doesn't mean you can't have bad scenarios. And so we're living in a world where we spend too much money. At this stage, markets are absorbing those deficits. Ray Dalio, you just mentioned him, he's cautioning about kind of the debt obligations to blow up in our face at some point. He doesn't use those words. And so that may well happen. The question is, will there be a quote-unquote reset? In order to have a reset, you need to have people come together in a room and agree on something. I have a very difficult time imagining that there's any sort of international agreement on anything. I happen to think that we have learned to ever look out more for our own interests as a government, and there be less and less cooperation. And I don't see that changing anytime soon. So as an investor, I think you're on your own. You have to deal in this world where there is no safety, there is no safe haven, and just throw out this notion of a risk-free asset and then build a portfolio based on that. But don't rely on your government to do it for you, type of thing, right? And so does it mean, is it gold that should be in your portfolio? Is it some other safe haven? Do you want to spread your money to a basket of currencies, or do you do it by navigating some other ways? You can try to minimize your risk and maximize your return, possibly, but what you don't have is safety. And so that's all I can say, and it's a long discussion to be taken offline for some other day. David.
Okay, next question comes from Frank. And the question is, how will rising corporate and sovereign debt and rising rates affect stocks in general and the markets, bonds, precious metals, and the dollar? Axel?
Well, the main thing is that as rates move higher, risk premium are going to rise. As risk premium are going to rise, financial conditions are going to deteriorate. And also volatility is going to increase. At this stage, we've had challenges in emerging markets, like the weak spots we've had in the markets, but we haven't seen many of the issues pop up in the US. And in the US, the Federal Reserve's job is to worry about the US. If you listen to Dallas Fed Kaplan, he has to worry about the rest of the world. He doesn't call the shots. And Powell worries about the US, and we haven't seen issues pop up that are significant. And so, yes, we'll march higher. It will be a headwind. Now, everything else equal, stock should be lower, but everything else is never equal. Earnings continue to move higher. Now, will it be different this time, that meaning that stocks are going to peak out before the economic cycle peaks out? Quite possibly. I don't know. If you bet on the traditional scenario, it's only going to peak out when the economy peaks and turns over. But of course, hey, can you predict exactly when the peak of the economy is? So you're getting into this gray zone. I think most people believe we are in late stages of this economic expansion. But does late mean it's tumbling over in a month? I don't think so. Some people think so. Or only in 2 years. I think 2 years is a little bit far out. But I continue to believe that at least for next year, the Fed is going to continue more than once, and quite possibly more than twice or even more than 3 times. David.
Okay, next question comes from Bernie, and the question is, how confident are you the Fed can engineer a soft landing? Axel?
0%. Next one. No, to expand on that, sometimes it happens that the Fed can engineer a soft landing. Now, I would actually not say that they engineer a soft landing, but sometimes it has happened that there has been a soft landing when the Fed has tightened. I think it is extremely difficult for the Fed to micromanage the economy. And the Fed is very well aware of that. Sometimes it just happens to work out. And the fact that they're quote unquote cautious doesn't make it any easier, because it just means that you have more excesses build up on the way up. And so I don't think so. I think this economic cycle is going to die the same death as most economic cycles do. The Fed will tighten into a slowing economy. And if you listen to the charts that I said, this very much seems to be the case, right? The sort of charts the Fed look at say that there is no storm on the horizon. Now, if you turn on CNBC, they say, oh my God, trade war with China, this and that. And who knows, maybe they're right. The Fed cannot afford to listen to the pundits on these shows. They need to look at the data. The data are always backward looking. Greenspan was one of the few people who kind of went out on a limb and said, hey, I got to tighten now because I see this on the horizon. Powell, being a lawyer, does not go out on a limb. That means by definition, he is going to be slow. That means by my interpretation, he will tighten into a slowing economy, which means, no, we're not going to have a soft landing in my view. Back to you.
Okay, next question is, do you think Mr. Trump would like to extend trade restrictions to slow down the growth and have a better economy in the spring of 2020? Axel?
Yeah, wouldn't it be great to have a good economy, at least going into the elections in 2020? And again, trying to engineer this is going to be very, very difficult. There is just so much momentum that an economy has that goes way beyond the tweet. It's just, you cannot micromanage the economy by tweeting. And that's no offense to Mr. Trump. I happen to think monetary policy is far more relevant than fiscal policy is in the medium term for an economy. And so all the show business aside of Mr. Trump, it's going to be very, very difficult for him to engineer anything. And if you think you can micromanage an economy with trade, good luck with that, right? Investment decisions are made based on perceptions of where things are going to head and what's going to happen. And so, yes, he can quote unquote have a deal, but are these deals really going to change things? And the challenge with China is, of course, that the disagreements are very severe. Can they come to terms? Now, the Chinese are playing the grown-ups here and are certainly trying to strike trade deals with the rest of Asia, with Europe, and just move on and just see, hey, maybe they can come up with something with Trump, maybe they cannot. Lighthizer seems to be driving those discussions right now. He is historically quite hostile to China, but he gets marching orders from the president. So I know as much as anybody does of how this is going to pan out. I would just try to keep a cool head with something like the arrest of that chief financial officer. It is a bit curious that they're arresting a person. They could have prosecuted the company without arresting this person. And so let's see how that theater plays out. But as we all know, Trump has always been ready for a good show. Maybe good is not the word everybody would use, but let's just say he's always been up for a show. And so, but that's just part of where we are, right? And it's part of the volatility. But much of, as you may also recall, the market had been shrugging off the volatility. Now it's not. Again, it is monetary policy. It's the fact that rates go higher that induces the volatility. It's then just journalists that then put into people's mouth that it is this particular tweet that that gets to do certain things. David.
Okay, next question comes from Phil, and the question is, what is the biggest hurdle for global equity markets? Is it potential trade wars, U.S. Fed raising interest rates, or shaky corporate debt loads, etc.? Axel?
Well, ultimately, just to stay on the theme, rates are the key driver here. Higher rates induce more volatility. Everything else equal, it warrants lower prices. Everything else is not equal. Earnings continue to move higher. With that, you can have higher prices, not necessarily so, but potentially so, right? And then, of course, and volatility is just a broad measure of fear, and that can come in all shapes and forms. During the long rally we had, we shrug off all these fear moments. We've had plenty of opportunity to panic, and the market didn't panic. The reason the market didn't panic was because of QE, because it takes away perceived risk. When the Fed buys bonds, it tells you, because of how the transfer mechanism works, is that, hey, we'll take care of you. There is no risk in the market. The Fed is moving away from that. It means you have to start thinking again. And so yes, I think rates is what drives the markets. David.
Okay. Next question is, would be interested in a review on gold, copper, and uranium. Axel?
Yeah, so I tend to focus on gold in these webinars, and I think I've given a view on that. Early in the new year, if there's interest, we'll go broader, talk more about gold mining companies, precious metals, and other things. So we might have a webinar dedicated to the metals. But stay tuned on that. Give us feedback on whether you want to have it. But we have some ideas there on how we might be able to address those questions more broadly. David?
Okay, next question comes from William, and the question is, I have read several well-known investors who have stated that the next recession will be vastly worse than 08-09. Under such a scenario, how do you think gold bullion would behave? Axel?
Worse than 08-09. Well, it sounds like a general fighting the last war. And they always keep in mind of who this quote-unquote well-known investor is. By phrasing it this way, it seems to me it's somebody who's trying to sell a newsletter who is not actually investing money. And the reason I just say that is, if it's really phrased that way, odds are that it's violating some regulations. And if you have a fiduciary duty and are regulated with the SEC, that's also, if you listen to me, I phrase things a tad more carefully than a newsletter writer who is not regulated. And so they can scare the hell out of you and get you to buy their product. That's not what we do. Now, that said, in 08-09, we had a seizing up of the financial markets. We had a real danger that there would be a deflationary implosion. Read Volcker's biography book that he recently published. It's a bit dry, but he says in this book that the only time to be concerned about deflation, by the way, he's very critical of the 2% inflation target. You shouldn't be worried about prices coming lower, but you should be worried about a collapse of the financial system, which was a risk in 2008. It was a risk in the Great Depression, amongst others. That's when you have these sort of concerns. We currently do not have that same threat level in the economy. Banks are not in that same situation. Now, that doesn't mean that there are not trouble spots out there. It doesn't mean you cannot have a blow up somewhere where you cause severe damage. I'm personally concerned, for example, about the concentration of risk in clearinghouses. And so, yes, there will be another crisis at some point. Doesn't mean it's that one. It could be some that we don't know about. For the time being, I think the more likely scenario is that the next recession is going to be an old-fashioned recession that the Fed tightens into a slowing economy. As boring as that sounds, that's not going to mean a massive blow-up. It may mean that there are bankruptcies with people that have too much debt. There are some people that point out that a very high number of companies do not have enough cash flow to service their debt. As the rates go higher, that might be an issue. And so, yes, those folks that quote unquote swim naked might be exposed then. And yes, I do believe gold is one of the diversifiers that investors could consider and should consider in that sort of environment. But I don't see that it's the same as a 2008, 2009 recession. I think it's going to be a very different one. Now, that said, in the next downturn, I do think that it is likely the Fed has to go down substantially. It is quite possible that they have to go down to near zero. And it is possible that they will have to, again, print money. I don't rule any of that out, and it's one of the reasons why I think gold may do well. I also happen to think that there are other ways one can do that, and you'd have to use some derivatives. Again, for those who want to learn about how to use them, drop me a note. One more question, David.
Okay, last question comes from Jason, and the question is, how do you recommend getting exposure to commodities, and which commodities? For example, pure gold bullion, gold mining stocks, other precious metals such as silver and platinum, commodity index, and the likes, etc. Axel?
A wonderful question. Again, it takes probably a long time to answer it. Each one of these choices have their merit, and for different types of investors might be different. Most importantly, they have different risk profiles, right? One of the reasons we like to quote gold is it's kind of simple. Simple in the sense that there's comparatively little industrial use, so the dynamics are much simpler than even when you move to silver already. The physical gold, one of the biggest advantages of physical gold is that you're not tempted to trade it, right? You put it in the safe, put it on your pillow, and then there's a disincentive to save because it's a pain. You've got to take it and take it to the dealer. If you buy gold through an ETF, it's much easier. If you have an ETF that provides deliverability, all the better. But and so you can get some of these advantages, don't have to worry about the storage yourself. If you go to gold mining companies, well, yeah, it's a different beast, right? It's a different risk profile. Those stocks tend to be volatile. The junior mining companies notoriously volatile. Now, are they a bad investment? No. They may be a very attractive investment if the price of gold goes up, except keep in mind, especially the junior mining companies are very dependent on credit because they tend to borrow a lot of money or need access to new equity funding. And so sometimes they haven't quite performed the way people expect. So you need to have somebody help you manage that, or you need to do your homework. They are certainly quite risky. And then, as I indicated, some other commodities, they have more complex dynamics. And then if you use derivatives to buy them, you certainly need to know what you're doing. And I can't have a kind of blanket recommendation here to do these things. You can talk to us, whether we can help you with that maybe, but I just want to keep it at that. So with that, before I pass it on to David to wrap it up, I hope everybody has a good holiday. Reach out to us if we can be of service to you. We can provide services, including free services to you, if you are a client of ours, if you work with us to support our research or whichever way. And so is that. I appreciate you kind of listening in, and we appreciate it as well if you reach out to us so we can help you. And then we will be in touch in the coming weeks with other things that we are doing. And I hope you kind of peek into the wonderful email that we send you, or follow me on social media. Twitter is the one where I'm most active on. Twitter is not for everybody, but if you're active on Twitter, do it, or reach out to me on LinkedIn. LinkedIn has kind of the right balance for those who don't want to look for too much material. And then obviously our newsletter is there as well. David, back to you.
Great, thanks, Axel. And that concludes the Q&A portion of our call. If we weren't able to get to your questions today, we will get back to you via email. If you have any additional questions or comments, go ahead and shoot us those questions over with the question through the text box, or you can email us at the Contact Us section of our website at merkinvestments.com. For future webinars, if there's a topic that you're particularly interested in and would like us to cover, let us know through the comments box. This concludes our call. Again, happy holidays, and we will see you in the next year. Have a great day.